Good morning and welcome to Matters Financial and Geopolitical from a Frontier. I hope the year's gone well. We've had a few days of it. I certainly have, but it's been so quiet on these Nairobi streets. It's been an absolute joy to get around. But I suspect from next week it's all change. International markets, Business Week's new cover, Trump took credit for stock market records. Does he deserve the blame for the plunge? Green means up and red means down in the stock market. Lately there have been many red days, but the true colour of today's market is golden orange, the hue of the pompadour atop the head of President Trump. Because for better and for worse, this has become Trump's stock market. Until October, the extended bull market was reasonably called the Trump bump. The decline over the past few months, particularly since the start of December, is the Trump slump. Few would dispute that Trump is a volatile personality who's having a volatile presidency. He's shaken the establishment to its roots. Yet for most of his time in office, volatility in the stock market was below its long-term average, with the exception of a spell in February and March. The Chicago Board Options Exchange Volatility Index hit 36 the day before Christmas, up from below 15 in the summer and the fall. Really good article. Have a read in full. Sometime around the start of October, though, something soured for stocks. The question is what? Who's to blame? After the failed Bay of Pigs invasion of Roofle, President John F. Kennedy said victory has 1,000 fathers, defeat is an orphan. Trump's leadership style is also wearing poorly. His strategy of keeping people guessing and off balance might work well with adversaries, but it alienates friends. I'm not aware of another US president trying to weaponize uncertainty. And for good reason. It harms American interests as well as foreign ones, as Stephen Davis. At times, Trump seems to be using presidential announcements to goose the market. Stocks rose on December the 31st, for example, after a weekend tweet in which he said that a phone call with Chinese President Xi Jinping on trade had gone well. But that tactic goes only so far. Investors can react badly if reality doesn't match expectations. Even some of Trump's biggest supporters see his boasting as an error. If you're going to tie yourself to the stock market, you're going to go down when it goes down, says Mosloo. As a political matter, he should have anticipated this. The Trump slump is a bigger phenomenon than just a downturn in the stock market, but every red day on Wall Street is another punch to the president's gut. 2nd of January, I said, we have all noted how a bump can morph into a slump real quick. Just look at Trump, I said. And that was the 2nd of January 2019. And then I found that on the 2nd of January 2018, I'd said President Trump has cloaked his administration in the righteousness of the markets, for example. JP Morgan Asset Management is keeping faith in the Fed and taking a contrarian bet on US interest rates to show it. While many have given up on the Federal Reserve's tightening path, Ramon Maranilla, a bond and currency investment specialist at the firm, says that view may underestimate the strength of the US economy. We could take advantage of this through Eurodollar futures. I made my first big money in Credit Suisse on Eurodollar futures, actually. And we're doing this to some degree, so the trade, which represents a small portion of JP Morgan Assets' risk budget, will pay off if our forecasts do play out and the markets are wrong. I tend to view that we're still going to get 2 rate hikes out of the States. But on the 24th of December, I said, how much higher will the Fed dial up rates? The markets are signaling not much more. We're now signaling a cut. Powell, I said, who has incurred Trump's wrath, predicted 2 more quarter-point hikes in 2019. And I concluded by saying a lot hinges on that outlook. The US 2-year yield has collapsed to 2.37% as the global slowdown is headline news in the US, essentially saying the Fed is done. US 2-year yield is now 60 basis points off its high water mark of less than 2 months ago, trading below the Fed funds rate, so markets expect rate cuts within the next 2 years. And I go back to something I said on the 31st of December last year. Folks are keenly looking for chinks in the US economy. If the US economy slows, I said, I can guarantee you the rest of the world will slow further. And yesterday we had a US December ISM Manufacturing drop by the most since 2008, fell to 54.1 from 59.3. That, of course, put a bid in all the currencies against the dollar. Let's go back to the currency markets. Euro dollar 113.93. Dollar index 96.369. Japanese yen, the Bank of Japan are back in the office and they've lifted the yen up to 108.20. Swiss franc 0.9876. The pound 126.37. The Australian dollar 0.7022. India rupee back below 70, 69.855. South Korean won 11.2375. Brazilian real 375.65. Egyptian pound 17.907. South African rand 14.294. This is a dollar index chart from Adam Mancini, who's turned bearish. I'm not as bearish as he is. 96.369. He's talking about it going lower towards the lower band in this chart. I'm still looking for 100, 105, 110. Euro dollar 113.80 or 85 last. And, what came into my mind was that sentence from the second coming, turning in the winding gyre. The rise and fall of companies. Apple 2 months ago was the undisputed #1 in the world with a market cap of $1 trillion. It's dipped below Google's market cap to world's #4 following a revenue warning. Markets are never static. Commodity markets, this is the commodity returns over 1 year, 3 years from Charlie Bilello. Look at cocoa. That's what supported Ghana and Ivory Coast this year in part. And also some sensible policy making. Ben Bernanke once said, people hold gold as protection against what we call tail risks. Really, really bad outcomes. Gold has got as high as 1,300. Now at 1295.43, I think it's topping. Crude oil has been on the mend, $47.28. Let's see how long that lasts. This is a photograph I took some years ago in Dubai in the afternoon. And the Financial Times is reporting that they're quoting Hasnain Malik. Dubai continues to grapple with oversupply of real estate, sluggish white-collar job growth, high cost of living, and tougher enforcement of financial regulation. The IMF is forecasting a rebound in growth from 3.3% in 2018 to 4.1% this year, as the city prepares to host the World Expo in 2020. Dubai's 2019 budget plan envisages steady spending on infrastructure ahead of the event, but the city-state's major business founders active in real estate, construction and retail have warned about slumps in revenue of as much as 40%. Real estate prices have fallen almost 30% from their 2014 peak, according to online portal Bayut. All these problems are coming at the same time, said one Emirati businessman. Wars and taxes are no good. Hoteliers have had to cut room rates to their lowest levels in 14 years to soak up the growing supply of new rooms. Sheikh Mohammed, who's been holding a number of meetings where he's been listening to attendees, but one attendee said, trouble is, it's too little, too late. There are bigger problems I'm going to touch on, and actually Hasnain touched on one of those in his quote. Let me just go back to it. Tougher enforcement of financial regulation. It's been a safe haven for ill-gotten gains. It isn't anymore. That's a big problem. To wit, Justice Department is baring its fangs these days, and I was saying Dubai in particular seems to be no longer a safe haven for those types of funds, and I think the Dubai authorities are giving up all the information that's being requested at the moment. Hasnan of Exotics also said, but its role as a regional hub remains unrivaled. He's quite correct, and I wrote about this in February 2014. I said Dubai is the real transit state, a connection point in an interconnected century. This is a photograph of Dubai from the sky that I took. Holger tweeted about the Turkish lira's flash crash. Have a look at the chart to get a feel of how sharply it did fall.